Good evening, everyone. Welcome to Curiosity Talks, sessions brought to you by Wisdom Circle to provide information and engagement to all you curious folks. Today's speaker, Vishwanath Kudva, is a perfect example of a successful pivot in a career. Vishwanath is a mechanical engineer who, after 15 years in corporate life, turned to the stock market. Since 2006, he is a full-time investor following his lifelong passion. Welcome to Curiosity Talks, Vishwanath.
Thank you.
Thank you so much for being here. So I think everyone is eager to, gain the knowledge that you have. So I want to start with the basics and ask you, what are the capital markets?
Hello, everyone. It's a pleasure to interact with all of you today. For the next few minutes, this is going to be a little textbook kind of a thing before we get into the fun part. So you'll have to bear with me. In any country, there is an entrepreneur. There are entrepreneurs who run their own businesses. They have started this business with their own capital or borrowed from friends and family. Now, at some point of time, the entrepreneur may decide that they want to get publicly listed, which means they want public money. And why would they want that? Maybe they have ambitions and not enough capital to meet those ambitions. Maybe they don't want to take all the risk themselves, even though they have the capital. Or sometimes listing gives you better credibility with customers and with your bankers and better terms. That is why they would want to get listed. Now the question comes, they might want your capital, but how are they going to find you? How are they going to find the investors who are willing to put money into their business? On the other side are folks like us. We want returns by investing in good businesses. But then the question comes, how are we going to locate those entrepreneurs and those businesses which are willing to take us as partners? This is where the capital markets come in. The capital markets is a marketplace where financial instruments of different kinds, maybe bonds, debentures, shares, and derivatives, commodities, are issued and traded. All these financial instruments are issued and traded. The share market is a part of capital markets, and the capital market can be further divided into primary market and secondary market. So, coming back to our entrepreneur who is now looking for public capital, he comes to the capital market. In the capital market, there is a price discovery kind of a mechanism where he offers his shares at a particular price, and people who want to invest in those shares, and thus the IPO is over. This is the capital market primary function. You will recognize that this is your IPO. Now, once the IPO is over, those who have invested may be looking for an exit. This is for multiple reasons again. They have lost trust in that company, or they have made enough money, or if it's a losing proposition, they want to cut their losses. For whatever reason, they want to sell. Now, obviously, they can't go back to the business owner and say, look, you took our money and gave us shares. Now take back our shares and give our money. This is where the secondary function of the capital market comes in. The capital market now provides a transparent way of doing price discovery and enabling trades so that those who want to exit can sell their shares and receive the money, and those who want to invest in the company can buy those shares and pay the money. So this is basically all that happens in the capital market. Speculators and traders sometimes treat the markets like a casino. But if you see in the background, all these important economic activities are going on. Nowhere is it something that has been opened for people to speculate with. And when we bring our capital to the table, we too enable nation building activities. We create jobs, we build infrastructure, we finance a lot of important economic activities for the nation. So, this in brief is what the capital markets are all about, and more specifically, the share market, which we will be speaking about.
And also, Vishwanath, to explain it a little further, and in the context of the capital markets that you spoke of, can we define what exactly is a share?
See, basically, a share in simple words, against what we just discussed, a share in simple words is partial ownership in an underlying business. As you saw, the entrepreneur's business is there, and we are the people who are putting in a little bit of money in that business. So, to the extent that we have invested in the business, we too are owners, but to a very small extent. And the other important thing is, most new investors miss that this is an underlying business,
Hmm.
which means suppose you are investing in one of the FMCG companies. If you see, this FMCG companies has dozens of products, millions of customers, thousands of employees, a nationwide distribution network, exports somewhere happening in the background, hundreds of vendors. Most of the time, we fail to realize that there is an underlying business beyond the price. Now, coming to investing itself in these shares. To have a successful investment, you require only two things. Is this a good business to invest in? And is this the right price? You get both of these right, and it's likely you will be a successful investor. You get both of these wrong, it's a definite loss. One of them right or wrong is a 50-50 kind of experience. So as we go ahead, we will see what we mean by a good business and what we mean by a good price.
I think we come to the exciting part of the discussion about why should we invest in shares?
I will start with the small advantages first. These are common with some other asset classes also in some instances. In some instances, they are unique to the stock market. First of all, it's an extremely transparent process, as you have seen. Everything is online. The price discovery happens in a very transparent manner. And it is clear what the asset is. One share of XYZ company means the same thing, irrespective of who is buying or selling in the world. It's not like, I thought 22 carat gold, but you offered me 18 carat gold. It's not like that. It is very clear what this particular share pertains to. Spreads are pretty low. Spread meaning you want to sell a share, you are expecting 1500 bucks. Somebody else says, I will give you 1499.95. There are very few markets in the world with a spread like that. Brokerage is low. Taxation, normally capital gains, at least for India, it's lower than the tax you would pay on salary income. Then there is no question like, somebody ran away with my shares or somebody vanished with my money. The clearing corporations and the stock exchanges are the guarantors for every transaction. Lastly, One small advantage is it's you and your device.
Hmm.
You don't go searching for sellers or searching for buyers. You don't negotiate with somebody over the phone. It's just you and your device, and online you are dealing with your shares. These are all the small advantages, but they are nothing compared to the two huge advantages. The first big advantage is the concept of limited liability. The limited liability concept means, in legal terms, the company is a separate legal entity, completely separate from its owners. Now, let me tell you in normal layman terms what we mean by that. I put 100,000 rupees and open a small tea shop outside my apartment. If that tea shop makes 600,000 rupees, all the profits are mine. If I lose 600,000 rupees and decide to sell and close the tea shop, I'm not off the hook. Bankers send me notices. Vendors turn up at the door. Employees want to be paid. Until I put up the amount of loss, I'm completely liable for the loss that the business has incurred. Now, instead of opening a tea shop, I put 100,000 in a company which runs a chain of tea shops. Now you see the fun. If the company makes 600,000 rupees on my investment of 100,000, the entire profit is to me. If the company loses 600,000 on my investment of 100,000, I am not liable. Nobody comes to my door. No bank sends me a notice. Nobody holds me responsible. I cannot tell you how big an advantage that is, that you can go to sleep at night knowing that the only money you can lose is the capital you have invested. Nothing more than that. The second advantage is it is universally considered that shares are your best hedge against inflation. Swati had sent out a questionnaire and I saw some of the answers. Some folks are still not convinced about that. I will give you data of 189 years. On any search engine, this is your homework.
Hmm.
Put 189-year study by Jeremy Siegel, Jeremy Siegel, Jeremy Siegel. He has shown in a study from 1802 to 1991 in the US stock markets that the US stock market has given an average return of 6.1% after considering inflation of roughly 2-3%. Many of you are much fascinated with gold. In India, that is a common this thing. Everybody loves gold, and gold, you have seen how it has moved in the last 1 or 2 years. In 189 years in the US markets, gold has given a return of 1% after inflation. Bonds have given a return of 2 to 3% after inflation. Therefore, gold is the only keeping up with inflation. It does not beat inflation. Shares are your best bet. Now the question comes, why would shares be the best bet, right? Any example that we can think of? Look, take a loaf of bread. What does it cost in India? Maybe 60 bucks. A company makes 5 rupees on that loaf of bread, correct? Now, in 10 years, let us say the loaf of bread costs you 120 rupees. The profit for the company is no longer 5 rupees, it is 10 bucks. So the profit of the company has doubled. So inflation, in a way, helps shares stock market investors.
Hmm.
Now, doubling of the price in 10 years has led to doubling of profit, is one part of it. The company is obviously not going to be satisfied with selling the same number of loaves of bread after 10 years what it does today. So it will probably expand its business 2 3 times. It will do some exports. It will get into maybe allied products like bun or cookies and stuff. So the profit will go up some 3 4 times, including inflation. And the general wisdom in the market is if the profit of a company goes up 4 times, then the share price should also rise 4 times. This is the basic thing about why, what are the advantages.
And I think this might be a good time to jump in and talk about what we were discussing earlier, the investing in share market, pre-internet and post-internet. You told us some interesting facts.
Yeah, see, basically pre internet, we did not have enough access to data. Post internet, you had 10-year data, 10-year profits, 10-year price range. And you will see as we move ahead how all this data helps you to make better decisions.
So, specific to share market investing, can we start with the basic principles that we need to keep in mind? What is your advice on that?
Look, many of you may be owning an apartment or a house. How many of you go to the real estate broker every day and ask him, what is the rate of my house today? The problem is we confuse necessity with availability. Just because the market is giving you a quote every minute or every second does not mean we need to act on it.
Hmm.
If I were to cycle back to you and ask, why don't you go to the broker every day and ask him what your apartment is worth?
Hmm.
You would say, what does it matter? The price is important to me at only 2 points.
Yeah.
When I bought the apartment and when I sell the apartment. In
Correct.
between, the price can go up and down for all it likes. What does it matter to me? The same concept is what we need to bring to the stock market. It's like, a never ending cricket match. Somebody is bowling at the other end all the time. You don't need to try and whack it for a six on every ball.
Yeah.
That person is going to keep bowling. You only choose to touch those balls that you feel are worth hitting out. The rest of the time, you do nothing.
Hmm.
Now, that is why I would say we need to look at the dichotomy between price and value. The value of your apartment never changed, or maybe it gradually went up over a period of time. The price kept fluctuating, correct? Similarly, let us say there is a company with a 10-year track record of continuously rising profits. Is there any logic why the price should go up and down? Is it not logically, at least for a lay person, to say the company's profits are going up continuously, is becoming more and more valuable? Price should stay steady or go up. But that is the nature of price.
Hmm.
Price will keep going up and down. We focus on the value. That is all. And that is why we come to what we call the art of investing which is the qualitative factors, and the math of investing, which is the quantitative factor.
So, could you explain the term art of investing?
See, first we start with the qualitative factor, which is the art of investing. Here, what we do is we try to answer the first question we raised. Is this a good business to invest in? Now, if I were to ask you a question, a simple question, and that is, how would you define a great company, a great business? What would you say? A lot of things will come to your mind. Uh, are the promoters good? Is the product necessary? Will they be around another 10, 15 years? Do they have a durable competitive advantage? Surprisingly, when some TV channel or newspaper says buy this company, most folks don't look at all these characteristics of a great company. And that is where the qualitative factors come into play. And for those of you who are new to the market, the qualitative factor is equally, if not more important than the quantitative factors. I will run through a few. There are many. We will run through the important ones.
Yeah.
Promoter, quality of promoter is very clear. He is the managing partner. You are a sleeping partner. There is not one corporate development that you can influence on your own. Therefore, the promoter, you hope she is ethical, which is the most important thing. You don't want him or her to be stealing from the company and shortchanging you. Secondly, do they have a great vision for their company? And three, just having a great vision means nothing. Do they have the capability to turn that vision into reality? Next comes, is there a durable competitive advantage that makes people prefer this company over its competitor? Which in simple term we call a moat. Something that makes this company stand out and gives it a marketing and a competitive edge over over all its competitors, and maintains that edge for the foreseeable future. It's not it's not an advantage for a few days or months or whatever. It is for the foreseeable future, what we call a durable competitive advantage, maybe for the next 10 years or 20 years or 30 years. Then there are factors, when we say a great company, do they have products and services that people require? And things like that. This is the main thing. So it all boils down to three words: know your business. First word, know. The more you know about the company you are investing, the better. Who are the suppliers? Who are the customers? What is their product? What is the services that they provide? What is the demand for it? What is the market for it? Is it a good sector to invest in? Basically, the more you read and the more you know about the company, the better. The second word is your. If you have a feeling that this is my company, you will be more enthused to go out and find out more about it. And that itself will make you read more about the company. And there will be a sense of belonging that you have that makes you proud to be a member of that company. Whether it is a small thing like our Prime Minister inaugurating a world class bridge from one of our companies, or a Heidel project in a foreign country, or it may be as simple as we make the best bread which we have for breakfast every day, or we make India's best sweaters. That sense of belonging and that sense of ownership, I believe, is important. The last word, business, is in complete contrast to the Initial word your. If you find ethical behavior, if you find that the company does not look like it's going to survive long term, if you find that they are getting into something that is maybe not environmentally friendly or causing too many climate issues, you are better off taking your money and walking out.
Mm.
I have been known to have been a shareholder of a company, proud shareholder of a company for a decade or more before dumping it in 10 minutes the next morning, just because previous day they said we are not only in the consumer goods business, we are going to be India's largest pesticide manufacturer. So these are, personal things, but know your business are three words that we need to always keep in mind.
And I think this is the right time, Vishwanath, for you to take us into the math of investing.
My wife and I met somebody a few years ago.
Hmm.
She asked me, do you write your own algorithms or do you take it ready made from some institution?
Okay.
Then she asked a follow on question, what about technical analysis and mathematical models? She wouldn't believe me when I told her I use primary level arithmetic and common sense.
Hmm.
That is all that I believe is necessary. So here now we are trying to determine, is this the right price for a company, right? We already did whatever is this a good business?
Yeah.
There are three simple things that I started with.
Hmm.
To this day, I use them. One, any company that I invest in should have a 3 to 5 year profit track record, a track record of continuous 3 to 5 year profits. This is completely non negotiable in most cases. Now, I'm sure there are participants who are thinking, does that mean you missed all the new age companies? The Eternals, the Nikas, the Policy Bazaars, and all. I have invested in them selectively, knowing that they will be an exception to this rule.
Hmm.
It means you say, okay, for 10% of my portfolio, these companies look extremely attractive because they have a very good business model or something unique about them. So I will keep this rule to the side. Maybe 1 in 10 or 1 in 15 companies you do this, which is far better than saying, I don't look at financials at all and going ahead and investing. So I repeat again, 3 to 5 year track record of profits. The second thing is, who is the company making profit for? For its owners or for the banks? Which means you don't want companies with high debt levels whose profit is mostly going into paying interest.
Hmm.
Therefore, any business that I invest in, I would like to see low debt levels. To put it into figures, what do you mean by low debt levels? An interest coverage ratio greater than 3. The third rule that I follow is, for any company, you have something called a 52-week high and a 52-week low. The highest price reached in a year and lowest price reached in a year. I try to buy the shares of a company as close to the 52-week low as possible. Three simple rules. Even school children can use these rules, right? So I started with these. It worked fine for a long period of time, but I kept hitting three problems. Let us say I'm planning to buy a company at 700 rupees. I determine that this is a good rate. Okay. How do I adjust for rising or falling profits?
Mm.
If I've paid 700 this year, next year profit rises 17%. A year after that, it falls 5%. Year after that, rises 3%. Now, what is the correct rate to pay for this share? Problem one. Problem two, how do I adjust price for change in equity capital?
Mm.
Same company, 700 rupees you paid this year. He gave a 1 is to 5 rights issue, 1 is to 2 bonus issue, and split his share from rupees 10 to rupees 5. Now tell me what is the rate you are willing to pay. Problem 3, can I do at least some adjustment for general bullish and bearish conditions? Same company, 700 rupees 52-week low, 1000 rupees 52-week high. Next year, highly bullish conditions. 52-week low itself is 1200, which is more than the 52-week high of the previous year. What do you do now? So, to try, I was grappling with these issues for a long time before I devised a simple tool which I call the stock price forecast tool, which we shall now see on screen. Just 8 lines. First row, insert profit after tax for the past 10 years. Only care you should take here is any one-time non-recurring item, remove it and don't let it be in the profit after tax. For example, some division was sold, or there was one time some legal issue which for which they had to pay a heavy penalty, something like that. So simply put the operating profit after tax in your row number 1. Row number 1, by which I mean serial number 1, PAT. Second line, the increase in PAT of 1 year compared to previous year. This row is completely optional. It has no bearing into our calculations. It is just good to have because you see how the company is progressing. Row 3 is number of shares. By number of shares, you have to put here the number of shares that comprise the equity capital of the company. The only thing you need to note here is keep in mind the face value. So you get the exact number of shares. Fourth is the EPS, which is basically row 1 PAT divided by number of shares. Row 5 is 52-week high for the year, each year, which you key in. Row 6 is 52-week low. Row 7 is PE high, which is basically row 5 price high to EPS, and row 8 is PE low. I know we are going a little quick over this, but there is an example coming up where you will see exactly how this has been used. We will go to that.
We're not going, we don't have to go into this, no?
No, this is for financial institutions. You can use price to book instead of price to earnings.
So we'll go into the example.
Example. That will make it more clear because
Yeah.
here it becomes a little less easy to see. This is a real company, real data. Okay. I have only kept the company name hidden, right? So you will see first line all the PAT for the last 10 years. You can see the percentage increase. You can see the number of shares, the EPS, which is calculated PAT divided by number of shares, price high, price low for every year, and PE high and PE low. There's something very important here in the mechanics which I want to explain. This is important, please keep in mind. Wherever it is in black, up till 2025, we have price high and price low already available, correct? The 52-week high and 52-week low we have available. So row 5 and row 6 is what we key in. Row 7, row 8 are automatically calculated. Where it is in blue, the PE high and PE low is what we key in and let it calculate the price by using the formula price is equal to EPS into PE. I will repeat myself. Up till 2025, because we have actual high and low data, PE is calculated as price divided by EPS. Now for 2026 and 2027, we are trying to predict the price. So we figure out what is the PE ratio that is good for this company, and then let it calculate the price as price is equal to PE by E into EPS. Okay, so far? Now, you will see what a powerful tool this is, though it is so simple, and why it is the mainstay of my investing decisions. The first thing is you will see you can get a 10-year view of the profits. You see the number of shares. You see that in some years there have been buybacks and bonuses. Automatically, it has calculated what will be the EPS based on that. So it has adjusted for PAT, it has adjusted for change in capital. Now, what I want you to do is take a look from 2020 to 2025. Look at the PE low, which is row number 8. PE low 21.7 for 2021, 17.6, 18.6, 21.3, 20.3. Row 8. Row 8. PE low from 2021 to 2025. 21.7, 17.6, 18.6, 21.3, 20.3. What is the conclusion I can take from this? That every year the share hits a P low of 21. Has it not done that every year for the last 5 years? So I have basically taken that. I've made it more refined to 20.8. You can take it as 21. Now look at row 7, PE high, serial number 7. Same 2021 onwards or even 2020 onwards. 23.3, 33.6, 27.3, 27.6, 34.4, 21, 31.4. It is clear to me that this share deserves a P ratio of 27. Therefore, all that I do is whenever the share hits a P ratio of 21, which translate to 1276, I am a buyer. Whenever it goes to a P ratio of 27, which translates to 1694, I am a seller. As simple as that. Now the power is with me. I don't expect TVs or newspapers to tell me what is a good rate to buy for this share. 2027, you will see there is already one column created. All that we will do is, for those from outside India, we follow a year ending April to March. So what we will do is, when the June results, quarterly results come in, we will delete the results. We will subtract the results of June 2025 from the annual figures for the previous year and add the results for June 2026. So basically, we are doing rolling quarters. So the 2027 one, which you see PAT as 16652, once you delete the previous June quarter, add the current June quarter, it may become say 17,000 or 1700 and something. Automatically EPS will change. Automatically price high, price low will change. We will start taking that as the guidance for our buy and sell decisions. That completes the math part of it.
I can stop share now.
Yeah, please.
So, going on from that, can we do a comparison of shares vis-a-vis a few other investment vehicles,
Yeah.
either within or outside the stock market?
Yeah. So look, basically, day trading, margin trading, F&O, derivatives, I do none of those. And I have never done any of those.
Hmm.
Okay. The main reason is three things. One, shares give me limited liability, right? What we discussed. None of the other products do. You could lose abnormal amounts of money in it, right? Second thing is, I'm direction agnostic. All good long term investors are direction agnostic. By that, what I mean is, let's say I've determined 700 is a good rate to buy a share. Goes up from there, I will sell. Goes down from there, I will buy. I don't have a preference which direction you should go in. Correct? The third thing that is important is that I do not place a time restriction on myself.
Hmm.
If it takes 1 month to do it, no issues to get a profit. If it takes 1 year, I can wait. I can wait up to 5 to 7 years to make a profit. So that is the main important thing about this thing.
So, supposing Vishwanath, after listening to you, someone like me is enthused
Yeah,
to invest in the share market,
yeah.
what are the things that we should keep in mind?
See, the first thing that you have to do is that you have to first identify the business, have a buy and sell price point for that business, and execute only when those price points are reached. So sometimes it may happen that you may buy 12 companies in a day, and sometimes you may have nothing to do for the next 6 months. That is fine. The discipline to maintain that is important. The second thing that you need to do is always have free shares.
Hmm.
This is a very important concept. So I will spend half a minute here. Suppose you buy 1,000 shares at rupees 80. So your the amount you have invested is 80,000. That share goes up to 100 rupees or $100. What would you do? Is my question. You're getting a 25% profit. What would you do?
Hmm.
Most folk will say one of the two things. I will sell and take my profits. Or they will say, no, I can get much more. Why should I bother to sell cheap? My method is simple. You invested in 1,000 shares at 80 bucks, putting 80,000 rupees. When it goes to 100 bucks, sell 800 shares.
Hmm.
Your capital of 80,000 is back in your pocket. Hold the 200 shares long term. You get an opportunity to do this again. Repeat the process, increase your free shares from 200 to 400.
Okay.
There are companies I've entered and exited maybe 10 times, 15 times, 20 times, but each time incrementally increasing the free shares.
Okay.
This is the important thing that you need to do.
To ask a question on behalf of the Wisdom Circle community,
Yes.
would you have any specific advice for those who are recently retired? What should they be looking at?
The first thing to know is that it is never too late to start. 92% of Warren Buffett's wealth came after the age of 60.
Hmm.
Now, before you start thinking, oh, Warren Buffett is the world's best investor, how is that relevant to us? Quick example, 25 years ago, I bought shares of a company at 25 rupees. Today, that and sold within few months for 40 bucks. Today, that company is at 6,500, 30 years later. If you compare 25 bucks to 6,500, and if I was 60 years old 30 years ago, 99.5% of my wealth would have come after the age of 60. So never too late to start. Second, quick tip that I want to give those who have recently retired is, while what I do looks like a lot of work, and it is, passive investment also works. Buy 10 reasonably good companies at reasonable prices. Do nothing on it for the next 10 years. Don't even look at it. At the end of 10 years, this is what I would expect you to see. If your luck is bad, one company has gone bankrupt. Two are where they are. Three have doubled.
Hmm.
Another two have gone up 4 times. So your initial capital will have gone up 3 or 4 times. So this is the two things I would tell those who are recently retired.
And for any investor, are there any strategies for risk reduction? Because
For
I'm sure
risk
that is a concern.
risk reduction, you have to free shares.
Okay.
As soon as possible, take your capital out, like I mentioned earlier, and let your profits run in the market. This is your first thing. Second thing is, not more than 10% of your invested amount in one company, and not more than 25% of your invested amount in one sector. So minimum of 4 sectors in your portfolio and a minimum of 10 companies in your portfolio. The
Hmm.
last thing I would like to say is, there is a tripod. You can think of it as a tripod. Okay, price is one leg of the tripod,
Hmm.
which we already saw.
Right.
Performance is one leg of the tripod,
Yeah.
which is your quarterly and annual results.
Hmm.
Sometimes they come good, sometimes they don't come bad. That's okay.
Okay.
The third thing is important, third leg of the tripod, what I call the story.
Hmm.
Sometimes the story changes very quickly. Sometimes it doesn't change for decades.
Okay.
Most of my thinking, the brain power part, is on the story. What is the essence of that company, and is the essence changing?
Hmm.
Two quick examples. I have been part of a shareholder of a media company, newspaper company, since its IPO 20 years ago.
Hmm.
Every year I check once when the results come in. What are they doing for Gen Z?
Okay.
Because I'm not sure Gen Z necessarily reads or subscribes to newspapers. They get their news from somewhere else.
Hmm.
They may not be getting a newspaper home, but they get their news from somewhere else. What is my company doing to meet their requirements?
Hmm.
Sometimes the story changes overnight, like what happened with the change of rules for the gaming companies.
Right.
So you have to essentially keep in mind, when you are a long term investor, whether passive or active, whether the story is changing.
Hmm.
As long as the story holds
Yeah.
and the performance is coming, you don't even have to look at the company.
Hmm.
That is the main part of it.
I think what you just said is that the art of investing is just as important as the math of investing.
Correct, correct, correct.
Can you, Vishwanath, take us through an end-to-end investment idea, like identification and investing and expectations?
Yes, I will do that. See, first thing you have to accept is a good idea can come from anywhere as long as you read and as long as you observe. It might be
Hmm.
a product you use or a company you have had a good experience with. A good idea can come from anywhere. One day, as I was driving, I see a non banking finance company with a logo strangely familiar.
Hmm.
I said, where's that? Where have I seen that logo? And then I realized it belongs to one of India's best banks.
Okay.
This was some years ago, right? So
Hmm.
I'm wondering how come they are using the same logo? So I do a bit of research and find that India, one of India's best banks, owns that finance company, right? So here's what I did. I looked into that finance company, turned out to be an excellent one. Their IPO came last year. I will tell you in quick succession what all happened. IPO comes at 740, lists at 820, goes up to 890.
Hmm.
By now, participants know what I must have done. Freed my shares, took back my capital, held on to free shares.
Hmm.
Next thing I know, from 890, it falls all the way up to 550, going below IPO price. I saw on chat window somebody asking, what do you do when price goes down drastically? I love companies which give me their shares at a discount. As long as the story is good, as long as the
Yeah.
company is solid, the more it falls, the more aggressively I will buy.
Okay.
So I started buying again at 740. My last purchase was at 557,
Hmm.
all the way down. Buying something like, 100 shares or 10 shares, around value 7 8,000. 10 shares on every 5 rupee fall from 740 all the way up to 557. Brought down my average also. Now today it has gone back to 760.
Hmm.
I am keeping quiet,
Hmm.
waiting for 820, which is 10% above my IPO price.
Yeah.
It's not 10% above my average buy. My average buy is far lower, having bought all the way down to 560. 10% above average, above IPO price. At 820, second round of freeing starts.
Hmm.
Second round of taking out the capital and incrementally increasing my free share starts. Once all my capital is out, I have from the first time free shares, second time free shares, which is now a sizable chunk.
Right.
Now I wait for the third opportunity.
Hmm.
Quick feedback. Some folks asked me, where do you think this share will be 1 year from now?
Hmm.
Nobody can answer that.
Okay.
Nobody told you it's going till 890, and definitely no newspaper or magazine said it is going down till 550.
Yeah.
Then what is the basis on which we invest? My feeling is in the next 12 years, the price of this share will be three times what it is today. Now, you will definitely ask me what is the basis for that.
Hmm.
For that, we look into its track record.
Okay.
This company has increased its assets under management 10 times in 12 years.
Hmm.
It has increased its profit 7 times in 12 years in the past. So I'm saying a company which increased its profits 7 times in 12 years, can't it do it at least 3 times over the next 12 years. If it increases its profit 3 times over the next 12 years, the share price will match that.
Okay.
Because in the long run, the share price moves in tandem with performance. In the short run, it can go up and down.
Hmm.
So this is your example.
So I think there are a few questions
Yeah.
in the chat which Mansi will read out. But before we go to that, is there anything that you would like to add in conclusion before we go into the questions?
Only the disclaimers. I'm not involved with anybody else's money. I'm not a paid or unpaid advisor. I do not review portfolios. I do not manage anybody's funds. My reaching out to folks is always academic.
Right.
It is in the service of the stock markets to ensure that people are better investors. And any company that we may have discussed, I have a vested interest in all of them.
Okay. Good to hear that. Mansi, would you like to read out the few questions that we have?
Yes, absolutely. Thank you so much, sir, for such a wonderful session. So I think one recurring question that people had was, what is the best source of getting this 10 years of data for a company and basically deciding whether you want to invest in that or not?
Perfect. See, one of the things that you can do is go either to the company's website or go to Screener, and you will get 10-year profit track record, and you will get also 10 years of equity capital record. Now comes the question now. So PAT and your capital, equity capital you will get from Screener or company. To get 10 years of price data for a company, go to the quotes page on BSE or NSE, wherever you can see the quote of that company. Below, you will find one tab called historical data. Under historical data, you will find the words yearly high and low. So you put each year, you say, suppose you put 2016, it will show you 52-week high for 2016 and 52-week low for 2016. So all the data that we needed for the stock price forecast tool is there in these websites.
So one of the more recent questions that have come in is, what is the stock market index and how come it has gone up so much over the years, BSE and NSE?
Excellent question. See, one of the first things, this is an excellent question because this is one thing I would have wanted to mention. The stock market index is something I do not look at all. Okay. I always say, if you are in the habit of making homemade jam, fruit jam, do you buy fruit when fruit is cheap, or do you buy fruit when the inflation rate in the newspaper is low? Nobody does that, right? You don't look at inflation rate before going out to buy fruits or vegetables. Now, that looks like a silly question.
Hmm.
But the fact remains that Nifty is about 50 stocks. Sensex is 30 stocks. There are 5,000 listed stocks in the stock market. Why would you decide whether to buy or not a particular stock out of the 4,950 which are not in the index based on how the index is going up or down? So people sometimes ask me, आज market कैसा था? How was the market today? Is it up or down? Irrelevant.
Hmm.
The market is always good. The question is it good for buyers today or is it good for sellers today?
Yeah.
When I get onto my screen in the morning, I don't look at the Sensex, I don't look at the Nifty levels, I don't see how many points is up or down. Most days, I can't tell you what the Sensex or Nifty levels are. What I look at is my 30 companies are there, their prices are there. Does any of this warrant buying or selling? That's it.
Thank you. Vishwanath, I'm wondering whether I could send you the remaining. There are quite a few questions. If I could
Sure.
send you the questions, would you be
Sure.
able to answer them, and I could just share it with the group? Would that be
Sure.
possible?
You're welcome to give my email ID, for
Okay.
example, to your
Okay.
members. No
Okay.
issues at all, and I'll be glad to answer questions. But
Wonderful.
as I mentioned, I will not get into advisory roles.
Right. Right.
A lot of times people send me questions asking what I bought this thing, should I sell it, should I buy more?
Right. Right.
Those kind of things normally I stay out of.
Okay, so I will do that. I will share your contact email with the group,
Yes.
and if they have any questions, they can reach out. I want to thank you for this wonderful 1 hour that you have spent with us. It has been very enlightening and very informative, and we are grateful for your knowledge and your insight. Thank you so much.
My thanks to Wisdom Circle, Swati, Mansi, and Kedar for making this happen. It was a pleasure to interact with all of you.
Thank you.